Hi, everyone. Thank you for joining this webinar. Uh, I don't know how you are feeling. I'm extremely excited to be part of this. We here depend on your support and patronage and your encouragement to keep growing and getting better. So it's a privilege to have this opportunity to interact with you. Uh, as you know, today the webinar is on US investing. Uh, I will set a premise with a small presentation for the first 20 minutes or so. I would like this to be as interactive as possible so that all of you ask as many doubts, whatever clarifications you have, and I will answer whatever I know. And so then we can keep it interactive and move on those lines. Before I go to the presentation, a brief intro on my background. So how did I gain some insights on US knowledge, US stock market, sorry, US stock market. So before I became a business journalist here at Business Line, I had a 14-year career where around 12 years of that was working for two US hedge funds. Those were quant funds that used to infuse or kind of fuse fundamental analysis into their quant outputs. So they had set up team in India to do fundamental research on US stocks. So, and I used to focus initially, I started researching on US telecom and media stocks. And then I moved on to covering US software and internet stocks. And much of the last 14 years, both professionally, the 14 years before I joined Business Line, both professionally and personally, I spent a lot of time researching on US stocks. And it's still a learning process. You never get to complete learning in stock markets. So what I've learned from 2007 till today, some insights, some perceptions I've gathered, will be happy to share it with you and receive your feedback on that as well. So I'll move on to the presentation, just a sec. Yeah. The first thing I want to say is that uh, give a brief what is the current context of US markets, okay? So we all know Trump has come with a landslide victory. There are going to be some policy changes. So where are the markets now, US markets now? So we'll just get some perspective on that. And so if you see, uh, these are kind of the returns that were first delivered in Trump's first term from 2016 to 20, and then Biden's term from 2020 to 24. So these are returns from election day to election day. Okay. So if you see the charts on the left of your screen, the markets have had a tremendous period in the last 8 years. There was a lot of upside during Trump's first term, and that has sustained during the Biden's term in the last 4 years. But what differentiates Trump's term and Biden's term? One important thing is the bond rout that played out in the last 4 years, which was a consequence of very high inflation. So if you see the inflation that played out in the US from middle or end of 2021 to early 2023 was probably the worst inflationary period there since the 1980s. Uh, Mid 80s, the US interest rates had gone up as high as 11, 12, 13% actually, the Fed rate, which is today at 4.75. So you can imagine the kind of inflation that people had endured in the 70s and 80s. And then aggressive central bank action actually quelled inflation that set a massive growth wave for growth wave over the next 3 decades. Okay, so what happened once inflation was quelled in by let's say late 80s and early 90s was that bonds, long-term bonds at the end of 1989-90 were yielding something like uh, you could say 15% interest per annum and all that. As inflation came in under control, long-term bonds started appreciating because as interest rates declined, bonds increase, the value of bonds increase. So there is actually a bond bull market in the US from 1990 89 till 2021. For most of this 30-year period, 31-year period, bonds outperformed equities. So if you had invested in bonds during, let's say, 1989, 90, or mid 90s also, yes, you would have actually outperformed S&P 500 or a Nasdaq or a Dow Jones for much of this period. Think about it. It's like bonds are risk-free instruments, but long-term bonds outperformed equities. That came to an end under Biden's term because of inflation. So if you actually see this Barclays iShares index, you have this 20 plus year index and 10 to 20-year index. So these are ETFs which invest in long-term government bonds, risk-free bonds. They were down a lot during Biden's term. The blue line, the blue bar is what you see happened during Biden's term, actually. So I think it will all be in your memory of the recent inflationary episodes and rate hikes by the Fed. So that is one big differentiator. Bond investors have taken a route, actually. They've been routed literally. The only thing is that ultimately bonds are guaranteed, these treasury bonds are guaranteed by the government. You will get back your money, but you will, if you sell today midway, you're going to sell at a huge loss. So that's one thing. Gold kind of during Trump's term, gold went up towards the last year because of the COVID episode, and gold is both it's a hedge for safety, and it's also a hedge for inflation. So during Trump's term, towards the end, gold did well because amid uncertainty in economy, the safety hedge boosted gold. And then during Biden's term, the inflation hedge boosted gold. But so overall, if you see, Trump's term was more rewarding for investors than Biden. So what now investors are betting on is that uh, there will be a repeat of more equity returns. Trump's pro-business policies, tax cuts he implemented in his previous term, etc. But there are a few uh, there are a few contradictions in this because there are a few forces that are going to act against market under Trump's term now. So the next slide. So before that, so this is an example of the bond ETF, Treasury bond ETF. If you see, you can see how the it almost doubled for a long period of time, and then it crashed in the last 4 years from a peak, actually. So I just wanted to show this also. So going into what uh, where markets are actually. So if you actually see valuations in the US are at historical extremes. If you see the Dow Jones Industrial Average is trading at a P of 23.8 times. Historical 20-year average is 16.9. Okay, so S&P 500 currently at 26.3. Historical 20-year average 18.5. Nasdaq at 34.5 times. All these are trailing P's. At an index level, you can, while forward P's are better when you do stocks, at an index level, because it's an aggregate, you can be comfortable using the trailing P also. You can use forward or you can use trailing. Both will give you perspectives. And Nasdaq is also at a sizable premium. So Trump is taking over at a time when valuations are as excessive as they have ever been. Okay, so this valuation that you see in the index was last seen in 2020, late 2020, early 21. That time because the calendar year 2020 earnings was impacted by COVID lockdown. There was a one-time exceptional hit to earnings of companies that resulted in elevated PE, elevated trailing PE. So on a forward basis, they weren't that expensive because after the bottom of COVID, markets started looking to the future. So uh, markets were that expensive during an exceptional period in 2020. So we can't compare it with 2020 because there was an exceptional hit to earnings. This time, earnings are quite fine. In fact, earnings have been boosted on the positive side, contradictory to the impact in 2020. So what we are having now is a case of elevated valuations upon elevated earnings. So that is one risk. Okay. So what would happen if there is an earnings contraction in case a recession hits the US? Earnings will contract and PE will contract. So you'll have a double whammy wherein uh, stocks will fall because of earnings contraction, and stocks will fall on PE contraction upon the earnings contraction. So that is so you'll have to look at it like a compounded impact on stocks. So that is the risk that you will have to consider. I'll give you this example. Okay, uh, let us say the earnings of the index is 10 and the PE is 10. Okay, the value of the index will be 100. uh, but let us say earnings contracts by 50% to 5, and PE also. This is just an illustrative example, not something that I not don't take it literally, just to give a perspective. Let us say earnings falls by from 10 to 5, and P multiple 2 falls from 10 to 5. The value of the index will be 25. All right. So you have a 75% contraction in the index when actually the two variables that make up the index value, PE and earnings, have actually contracted only by 50%. So this is the risk you will have to keep in mind in case there is a downside. See, there is no evidence that the economy is going to suddenly slow drastically. Okay, so that is one reason that is keeping optimism in the markets quite buoyant. But when valuations are this high, we will have to be careful. Okay, we'll have to be very cautious. And the last time earnings were this high was during on a normalized earnings basis, like when there was no impact to the economy, like COVID and all that. Last time valuations were this high was during the dot-com boom. Even during 2007, if you see at the peak of the market, S&P 500 PE was only around 16 times, whereas now it is 26.3 times. So what you have to keep in mind is that a huge AI uh, optimism is baked into current valuations. Any slowdown in economy, any brick wall for the AI optimism can cause a lot of pain. And so these are some of the valuations, if you see, uh, uh, of the Magnificent Seven companies. If you see, all of them are quite expensive, mostly in the 30s, except Meta Platforms and Alphabet. Uh, Tesla is nearing 100 in valuation, a PE of 100. At the same time, for most of the companies, with the exception of Tesla, your earnings is actually slowing. So you all these companies have had very strong earnings in calendar year 24. For all these companies, earnings is going to slow down. The light blue bar is the growth that is expected for calendar year or FY25 earnings. The dark blue bar is what represents the current year earnings growth. So if you see, the growth is actually falling for all companies except Tesla. In terms of valuation, while Alphabet at 20 and Meta Platforms at 23 might look much cheaper than the other companies in the list. There is a reason why they trade at those level. Alphabet and Meta Platforms are ad dependent companies. Significant portion of the revenue comes from advertisements, unlike Apple or Nvidia, etc., where they have products, or in Microsoft, it's subscriptions, cloud, etc. So ad dependent companies tend to be more cyclical, and that is the reason, relatively more cyclical. All the Alphabet and Meta Platform earnings have been resilient in past down cycles. Because they're ad dependent, they will always have a lower valuation than the other big technology companies. And uh, investors are optimistic, but what about one of the greatest and investor with probably the best long-term track record, Warren Buffett? So if you see, his cash pile has been increasing substantially. He has over $300 billion in cash, and he's not comfortable investing. Trump has come back. There's a lot of optimism, but he is not showing the same level of optimism uh, uh, in the markets. So that is something to ponder over. To be clear, for example, during the 2000 uh, uh, 2002 to 2007 stock market boom, Buffett started getting cautious from 2004-5 itself. So just because Buffett has built his cash pile doesn't mean the crash is imminent or a correction is going to come. But you have to get careful. And actually, when the crash happened in 2008, the markets went back to the lows of 2000 2001 bear market. So which means although Buffett missed out the rally from 2004 to 7, which was almost a 3-year boom, of course he had his long-term investments. He missed out on making new investments and capitalizing on the growth from 2004 to 7. But he actually made up for it easily by investing at much lower levels in 2008. So the lessons we can take is whatever is the sentiment, optimism around, if you show patience, you will get, you'll keep getting good opportunities in the US markets to invest. I'll explain in later slides why the opportunities in the US market that you'll get will be more than in Indian markets. But before that, I would like to explain a few more things on factors that kind of reveal there are risks to the current rally. This is a chart of the market concentration. Okay, this is from 1990. If you see, even during the dot-com boom, the top 10 stocks account made up for around 27% of the S&P 500. During the 21 peak, markets had a US markets had a bear market in 2022 and 23. Indian markets didn't have. Nifty went down as much as 19%. So we avoided a bear market, but the US markets did not. If you see, at that peak, the market concentration was 31. Now it is 37%. The top 10 stocks, out of which 8 are technology stocks. Okay, 8 are technology stocks. And then the only 2 non-technology stocks are Berkshire Hathaway and Eli Lilly, which is a pharma company. So this is so much depends on so few. That is the risk, and within that so few, Nvidia determines a lot because a lot of boom over the last year is on AI, and Nvidia is the fulcrum of the AI rally. So, and then the other things, right? So, look at the government debt in the US. If you see, the US government has been on a debt binge. If you see, even during the 2004, okay, which was like debt to GDP was 61%. And then it was flattish. Then, if you see the first jump in the chart, it is when the global financial crisis happened. That is when globally governments went on a more aggressive fiscal stimulus and central banks went on a monetary stimulus, and that addiction to easy money has stayed around for a long period of time, which supported the equity rallies between from 2010 onwards. Although global GDP growth has been anemic, if you see 2003 to 7, that period was considered as one of the best phase for global GDP growth as a globally all countries put together uh, after since World War II. Okay, that was the kind of synchronized global GDP growth, including India. We went up as high as 9% growth, 8-9% growth. We had consistent 8-9% growth between 2006 to 2007 or early 2008. China was growing at over 10%. US was growing at 4-5%. So it was probably the best phase. So at that time, there was a flat line in government debt because tax revenues were buoyant and uh, the economy was good. After global financial crisis, the dependence on stimulus has become very strong, and as a result of which, government debt to GDP has increased. At 124%, it's quite high. Uh, People may say Japan has over 220% debt to GDP, but the dynamics are different. Okay, uh, Japan has flat. I mean, it has had low inflation, has had literally no GDP growth, very insignificant GDP growth in the last 30 years or so. Whereas the US continues to grow at 2-3%. Okay, And so at this rate, so much of debt, there will be inflation. So that is the uh, risk that kind of remains for the markets actually. So this debt is unsustainable for the characteristic of the US economy. So we can't say X, Y, Z countries have so much of debt, so US also can go, India also can go. No. The debt to GDP of any country is constrained by characteristics of that economy, your population, your culture, your interest rates, your the propensity for inflation to catch up, etc. So, considering all that, U.S. Debt to GDP is quite high as of now, which is one reason why gold has done well during Biden's term. And another thing to keep in perspective is that huge fiscal deficit is around 6%. If you see an emerging uh, country, emerging economy like India, has a lower fiscal deficit. We are now targeting 4.7 fiscal deficit for FY25. US, for being a much larger economy, has a higher fiscal deficit. Ideally, developed economies should have lower fiscal deficits. Okay, uh, but US has such a high fiscal deficit, and and this is during good times. So the concern for many people who have seen multiple cycles in the US market is uh, you're already at 6% fiscal deficit. What if a slowdown comes? Will you go to 10% fiscal deficit, 11% fiscal deficit? Your tools to support the economy are lower when you start with a high fiscal deficit. So so the key thing to note here is your uh, uh, ability to respond will be constrained at the time if and when. I mean, I wouldn't say if, because economic cycle means crisis will keep coming. Up down is how economy plays out. So when the next cycle comes, your ammunition is lower. So that is one big risk that is ahead for US markets. Uh, then this is the market cap to GDP. If you see, it's an all-time high. 2004, it was just above 100, like 111, 12, 212%, quite high. Buffett, in an old interview in 99, 2000, said his view. Uh, he said 100 times is when market cap to GDP is at around 100 times. It's a good time to start. It's good to invest 100 times or below. He said when you go to 175 to 200%, his exact words were, you are playing with fire. All right. So are the US markets playing with fire? We will know in future because they're at 212%. But the last time they went to this, so now it is even higher than 2021, 22 peak. Uh, and you can see how they have crashed from 22. Now they've recovered again because of the AI boom. Uh, so one thing is, yes, Buffett said this in 99, 2000 to some extent. Uh, Characteristics of economies have changed. For example, for many US companies, especially the technology companies, probably for most of the companies, okay, 50% or 55 uh, 50 to 55 or 45 to 50% of revenue comes from outside the US. So when you compare it with US GDP or restricting uh, it only to their business within the US. So now that the big techs are very global, uh, for example, all the big techs in India, their Indian businesses are as big as many of the Nifty listed companies, which one of the articles we had written in Business Line explained a month back. So that is the case for market cap to GDP to be higher than the 100. I mean, to be attractive even at levels above 100 when Buffett spoke in 2000. But this is extreme. I mean, you can be sure because even in 22 you have crashed. FY22 you have crashed from those levels. So yes, when there are so many risks, why do you still want to go to the US market? Because it is the cradle of innovation. Okay, so let's look at it this way. Innovation will have four requires four pillars. Okay, one is talent. We are, I mean, as an Indian, I feel we are as talented as anyone in the US. In fact, it is Indian talent that is driving many of the technology companies in the US. There are other talents like people from Taiwan. Culture for some reason in their culture, they are experts in semiconductors. So if you see Nvidia, uh, Jensen Huang is from Taiwan. The CEO of AMD is from Taiwan. So let's say Indians are as talented as, let's say, some from any of those countries, especially the US. But then there are a few other pillars also. Uh, the other is funding. They have lots more venture capital funding than we've got. Billions of dollars are pouring into OpenAI and many other startups working on AI. Some of it is coming to India, like some funds have been early investors in Indian startups. We've all seen new age companies come from VC money invested by US companies. But most of the allocation is mainly for US companies. So we need more funding. So that is one thing. Then the other thing is institutions, okay? We have great institutions like IITs, many engineering colleges. But where one advantage the US has is uh, there are so many institutions with so much of focus on scientific research. Uh, the the kind of funding they have for research makes certain innovations possible there. Like there are many research papers that result in a company mushrooming and then becoming a giant. For example, Google, the founders of Google were PhD students, and they're working on a paper, and that idea became the seeding intellectual capital for Google, which is now over a 2 trillion company. So we need institutions that will have to actually have there should be more uh, research at the like at the PhD level. We need to invest a lot. So that is one thing. We are making progress. Okay, like China started doing it in the last 2 decades. Now they have their own inbuilt, much more innovative technology industry. But as of now, we need to we'll have to. That is one pillar which we have to build more on. Then the so this is the third pillar. So I said one is talent. We have uh, funding the US is better. Institutions, because of the funding of institutions over the last 3 centuries, they have a lead over us. And then the fourth thing is ecosystem. Okay, you need an ecosystem where whether it is your supplier ecosystem in terms of hardware, software, or a customer ecosystem uh, to move forward on the innovation. For example, if you see many Indian software products, SaaS products, are actually first launched in the US. Like think of Freshworks, right? It's an Indian company. Although yes, now it has a headquarters in the US also. But you could say an Indian origin company with roots in India. Uh, but your customers are primarily from the US, the developed market. So the customer ecosystem, the supplier ecosystem needs to broaden in India. So this is the third pillar for innovation, the ecosystem. And the fourth thing is culture, right? Silicon Valley uh, is a is a place where failure is rewarded. The more startups you founded, you failed, there'll be somebody else who will say, wow, you learned from that experience. Your next idea, I'm more confident that it might succeed. So there is no stigma associated with failure. That is something also that will have to change here. So when we address all this, we will have our Nvidias, we will have our Teslas. We are starting there. But till we become similar to them on these lines, we have to go to the US to target the best of opportunities in artificial intelligence, in medical science, in biotechnology, etc. So that's one point I wanted to make. So you have to keep it in your radar. Okay, I'll give you another example. Let's say take semiconductors is one. Semiconductors is one industry where we've now embarked on, right? Micron is setting up a unit. If you go uh, look at the class, if you screen technology stocks in the US, no problem. If you look at the technology stocks in the US, there are around 100 semiconductor stocks. There are you'll have around 7 8 stocks that are makes that manufacture equipments that are required to make semiconductors. Then there are 7, 8 companies that make equipments that are required to test for testing semiconductor products. There are companies that make equipments for packaging semiconductor products. And then there are those design companies like Nvidia or Micron, etc. So if you see, semiconductor alone is like a nifty 100 kind of a cluster in the US, and all are going to be beneficiaries of AI. Uh, some companies are like 1 or 2 companies are European, like ARM is a British company. They design mobile chips. Then there is another company called ASML, which manufactures lithography machines, and that is the only company with capability to make a certain kind of lithography machines, which are required to manufacture semiconductor chips. So ASML NVIDIA chips cannot be manufactured without ASML machines. So it's like that. So if you see, the value chain in semiconductors is massive. I will just show you. For example, yeah. So then I'll just take another 10 minutes and then we'll go. So in case my presentation extends a little bit more, I'm happy to extend the Q&A session by another 10 minutes. So don't worry. Uh, so if you see, like, look at the semiconductor value chain. So many companies, each specializing, and many will be different beneficiaries of AI at a different point in time. So you'll have to get into the cluster and understand which company does what and try to monetize it at the right time. Another thing, like say, for example, look at the 2024 bar, which is the bottommost bar. Uh, uh, the capex of just 7 companies, out of which mainly are 4 companies: Amazon, Microsoft, Alphabet, Meta Platforms. Uh, they make up over $200 billion. Okay, uh, this is 50% more than the capex of FY25 estimated capex of the Indian government. Okay, that's uh, few companies are able to spend so much. So, and most of their spending is related to data centers, technology related to the US, etc. So, you can see how much money is flowing into the ecosystem of technology, and which is one more reason why you need to have many tech companies listed in the US on your radar. So this is it about where we are as far as why you have to consider US markets. And then, so how are you supposed to analyze? I will take more questions on this, so I'll keep my explanation on this brief. Uh, so one at the macro level, then there is the bottom up, okay? Macro level is important because, for example, I'll give this example, like the global financial crisis correction started happening in the US from January 2008. By March 2008, uh, Bear Stearns had corrected. I mean, Bear Stearns went bankrupt, and huge correction started after that. But Buffett never made any purchases till September, October 2008 after Lehman collapsed. Okay, so the markets had fallen a lot by September, and he got even better bargains. So getting some macro data points helps. The US has a plethora of monthly macro data points. For example, this is just for the month of November. Like if you see now, the first Friday of every month, you get the uh, employment data. You get CPI inflation in the first 12 days of the month. Then you get PC inflation data in the second half of the month. The Fed uses the PC inflation data, which is a modified version of the CPI for its interest rate decisions. There are multiple consumer sentiment surveys. There is monthly retail sales data. So if you see, there is a huge uh, uh, list of data that you'll be getting every month. So if you are a data junkie, you would love tracking the US markets because every data gives some insights. That is what many quant funds and hedge funds do. They use every data to glean more and more insights and come to a conclusion. Yes, there could be a risk of too much of data and information overload. Uh, People will have to find the balance between the two with experience, actually. Then on a uh, bottom up approach, 10Ks and 10Qs are extremely important documents. 10Qs are quarterly filings along with their quarterly data releases. They release their 10Qs, and each will be 80, 100-page documents detailing what is their business. 10Ks are more detailed. It will be explained what is the business, who are your major customers, who are your major suppliers, etc. So what we can do is, for example, let us say you are invested in a telecom equipment company. Okay, let's say when telecom companies like AT&T, Verizon, T-Mobile come out with their earnings, they will release their capex data. Their 10Ks and 10Qs will have who are their suppliers. You can make a read through from that into the equipment stock that you own to see whether it is a beneficiary from this data point, etc. So it's important to learn a lot going through the 10Ks, 10Qs, do a lot of research to understand companies bottom up. Besides that, there are many in FinTwit who give a lot of insights on companies. There is a blog called Seeking Alpha, which has really nice articles on individual stocks. These will be opinions of a fund manager or an individual investor. Not that everyone is right every time, but all are perspectives worth taking, considering, and then improving your understanding of the company and the US markets. Uh, then, if you are entering US markets, you have to brace for massive volatility. US markets have a kind of volatility that is incomparable with what happens in India. For example, this is the magnificent seven stocks amongst the highest value top stocks in the US, how much they fell during the 2020 to 22 and 23 bear market. Uh, a company like Tesla fell over 70%, Meta Platforms fell over 70%, Nvidia fell close to 70%. These are big companies, okay? You wouldn't see in India, we also had a correction in 2022, 23, but you didn't see India's large caps fall like this. So this is US markets for you. And then look at the flip side, okay? So let's see how, from the bottom, how much they have increased till date. Uh, Nvidia is up 1,200% from the lows. So it's up 12 times from the lows of the bear market. Meta Platforms is up over 500%. So this volatility gives you opportunities also. So which is why you have to have patience, because just because let's say you missed the 2020 to 22 rally in Nasdaq and in these technology companies, you got a wonderful opportunity in 23, N22 and N23, early 23, and then you could have ridden this wave. In fact, at business line, we had actually, this is something that I wanted to show. This is just an example. So, for example, when Meta Platforms fell to multi to a low to its lowest level since 2016 in October, November of 22, like the view was very bearish. It had fallen to 98 from over 370 within a year. Okay, and analysts were bearish. If you see in this article, there was a downgrade by Morgan Stanley. There's a downgrade by Cowen, another brokerage. Uh, media was pointing out the flurry of downgrades uh, that Meta was getting, and there were many bearish views. Uh, but at business line, this is the article we published. We said 5 reasons to buy Facebook when investors are pessimistic. So we asked investors to double down and buy Meta Platforms in 2 digits. We finally gave a book profit recommendation in 6 or 7 months back at around 460 or 470, because we thought 5x from the lows was quite good returns in such a short period of time to capitalize on. It's gone even further. So, but I think 5x is okay. If somebody had invested, they have nothing to regret just because Meta has gone up more. But what I wanted to point out is how to get this perspective will come only if you go through 10Ks, 10Qs. Sitting here, one reason why I could make this call far away from Wall Street was because I had followed Facebook quarterly earnings since the time it had got listed. So when you follow quarterly earnings, stock reactions, etc., you get to understand the DNA of the company. You get to understand the DNA of the management. You know what are their characteristics. So you get a good idea. Okay, this you'll get only if you've been doing it for years together. So that is something you will have to do if you want to uh, uh, capitalize on the US market. So one thing that I'd observed throughout my experience of tracking Facebook was that uh, Mark Zuckerberg and his team, they have a penchant for putting out the bad news first. And uh, they would like to give, let's say, they'd like to overstate the bad news, then uh, try to improve performance from there. So typically what Infosys had under Narayana Murthy, like under promise and over deliver. Okay. So if you had followed this company, then you will understand. So the point I want to make here is understanding the DNA of a company, which will come only with years of uh, tracking it. You can shorten the learning curve by putting in more hours, more hours, reading from experience. So, for example, I can pass on to you how to uh, understand the DNA of the company. Like you follow a few conference calls, stock reactions to earnings, etc. You will understand it. So that's something perspective I wanted to share. Then in terms of volatility, just say for example, this is the comparison between TCS and Accenture. Okay, uh, very similar companies. It's just that Accenture has a more consulting company, but largely similar exposure, etc. Uh, the revenue growth is in the last 5 years is exactly the same. Roughly around 10% CAGR is what both companies have delivered. But the yellow chart is Accenture and the blue chart is TCS. If you see, Accenture went up more than TCS, and from that peak, it fell more than TCS also. So this is another example of volatility in the US stocks. Then volatility varies according to sector. This is a comparison of semiconductor company Micron versus Oracle. Okay, I've taken two companies that are good in their space but are not the best. Like Oracle, like today's software, you could say Microsoft is probably the number one. In terms of semiconductors, you could say Nvidia is number one. So I've gone to the next set of companies. Yellow is Oracle and blue is Micron. If you see, Micron has more ups and downs, more deeper ups and downs. So that should explain to you that semiconductor stocks are more volatile. So try to look at long-term charts of companies, 10 years, 5 years, not 5 years, I would say 10 max charts. Looking at the how the chart, you don't have to be a chartist, okay? I'm a fundamental analyst. But looking at the flow of the charts, you can try to understand cyclicality and sensitivity of the business to different variables. Then another example of volatility, this is Snapchat in the last 1 year. Uh, Up 50%, down 30, 40%, then again up 50%. This is quarter after quarter. Do you understand? So each quarter result comes and the stock moves like this. And this is not a small stock, okay? It's like a multi-billion dollar stock. So another example of how volatile. Why is it? This is probably one of the favorite story, my favorite story. This is a company called Carvana, which actually uh, makes it possible for you to buy. You could call it the e-tailer for cars. Actually, you can log into their website, buy cars online, and it will be delivered uh, to your home. Actually, so like our innovation on quick commerce, they have an innovation on buying cars online, and it will be delivered to your doorsteps. See, from 2018 or so, it went from single digits to 400, fell all the way back to 4, and now is back at 240. So sensitivity to leverage, debt in your books, interest rates, cyclical slowdowns all cause this kind of volatility. So the most important takeaway from this is you buy a stock and it falls 50%, you should not be disheartened. You have to live with it because you've seen Nvidia's fallen 70%, Meta fell 70%. That is the nature of the market. So you shouldn't regret buying a stock and seeing it down 30, 40, 50%. If you're even more confident, you should double down, but you'll have to do your checks and do it. So that is one thing. That is one thing I will do it. Why is it so volatile? Because of this. One thing is a lot of algos. There are a lot of quant, like depending on news picked up, etc. Uh, uh, Trading firms buy, sell, etc. Then the other thing is passive investing. So this is the green line is passive investing, and red line is active investing. So as of now, if you see, passive investing is price insensitive buying. They don't care about prices. If you're a passive investor, you don't care about valuation. You just put it into the index, and the index and the ETF just has to buy the stock. So quants, passive investing, then sentiment speculation all cause this leverage, all cause this volatility. So yeah, so that's it. And then multiple sources of data points. I recommend that beyond 10Ks and 10Qs, Fred, which is if you just Google Fred, uh, your St. Louis Fed, you will get this. You have data going back to 100 years, Dow Jones charts, housing prices, inflation, etc. will be very helpful to understand certain things actually. So yes, so these are the primary things I wanted to explain. Uh, I'm happy to extend the session to the extent that you are fine. I'm ready to extend it by 20 minutes, uh, and I will be happy to answer your questions. Okay, so as a server, do you offer as a service? Uh, are you asking if you're asking whether I offer service on US stocks? No, I'm an employee of Business Line. So whatever are my views will come out either in my newspaper or on Twitter, which will also be linked to my company actually. Uh, how to survey? Just one sec. Let me see if I get the full question. Just a sec. I think I'm not able to see the questions.
How to survey which companies are in forefront of medical products slash AI innovation.
Okay, just one sec. Just a sec. Right. Yeah. So how to survey which companies are in forefront of medical products and AI innovation? Uh, so see this. You will see one thing is yes. So one of the I would recommend visiting few websites and probably subscribing uh, to learn a lot on US stocks and companies. I have learned a lot by reading the Wall Street Journal in my early years. They do excellent coverage of Wall Street, what is happening at Wall Street, etc. And then CNBC posts out many of the like you go to their website daily, you can see important stocks that are moving and which stocks like, and then obviously what are in the forefront of innovation, they will get some coverage actually. So that is one. So how do you know? You learn by reading newspapers. You get learn by subscribing to their web portals. You learn by there are many social media has many people tweeting out many interesting stuff. It's a process. Over a period of time, you will gradually figure out uh, which is what is interesting. Now, what I would say here is, for example, uh, check out the big companies in medical innovation, okay, the large ones, the large caps. And then at some point of time, the results will be impacted by the competition from some of these new innovative companies. So then you will hear about them. So you just, by following certain important news sources, social media, uh, we go into the 10Q, then there will be topics on emerging trends and threats to business. Then you Google and try to find out which companies are into this. So that is how you learn learn that. I hope I have answered your question. If you need more clarification, please write to BL Portfolio, and I'll be happy to reply back on that. What should be the US portfolio now? Yeah, my view is whole cash and wait. See, if you see in BL portfolio, we write on US stocks quite frequently, and but my last recommendation on a US stock was Alphabet in March or April of this year. Alphabet was at $135 that time. To now, it's at around 170 or uh, 170 or $180. So if you see, uh, uh, that was my last recommendation. After that, I'm looking forward to recommend a US stock. I'm not finding value. So this is my view. There'll be somebody who is bullish and will say Trump has come and uh, Trump has come and uh, so there is more upside. Elon Musk, AI, Department of Government Efficiency, etc. So I am not subscribing to that. I told you this big when in the introduction I gave you how expensive they are. I feel caution is warranted, which is one reason at BL portfolio also we have not recommended. Alphabet was our last recommendation. So my views sit in cash tight. Opportunities will come. What is the best way to invest in US? Okay, so this is, I think there are other experts in my team. I will probably ask them to write on this. We've written in the past on, we've tested some different brokerages and articles have been written. If you send an email to us, I can email back. If you send an email to BL Portfolio, I can send links to the earlier articles that we've written that can be helpful to you. If you need more clarity, you can write to us back. I'll ask one of my team members to research and write on this again. Yes, in my view, it would be good to wait. This okay. So let me make it clear. None of what I'm saying is recommendation. Okay, this is just to share perspectives, have a discussion. Would it be good to wait for a market correction in USA and buy? I would say even if this is my view, I would say see you will have to make a call based on how long is your investing journey. Let us say if your investing journey is another 30 years, 40 years, yes, you do an SIP now, it is going to work out for you. Let's say even if it is 20 years, it is going to work out for you. So it depends on your background, your overall financial asset base, your commitments, your time horizon, etc. At a broad level, I will say I think the valuations are expensive. Whether it is Nasdaq, as you if you see in the earlier chart, I said Nasdaq is at 35 times PE versus a historical 20-year evaluation of 26. It is expensive. So in my view, it's best to wait for your most individual stocks or Nasdaq. See, yes, it's an interesting question. So if tech domain is expensive and S&P 500 is too diverse, is S&P top 50 better for an Indian investor? It is not, because this top 50 is also again dominated only by the 10 companies I told you. Those top 10 companies make up 37% of the index. So they will make up even more percentage of the S&P 50. I don't have the exact number, but if they are 37% of 500 stocks, they have to be much more of 50 stocks, right? So it is still dominated by the AI stocks. So that's the point I want to make. Next question. Are there any specific themes? Yes, excellent question. With Trump's deregulation plan, there may be in oil and gas because he is a big proponent of fracking. Uh, so he is a big proponent of self-sufficiency in oil and gas. The other thing is, see, AI is going to be a huge energy guzzler. Okay, so the focus is now they're reviving nuclear energy plants, and then they are also uh, the Biden team has been investing in renewables. Trump might focus on more on natural gas as a source for energy and all that. So AI energy guzzler. So to that extent, yes, oil and gas will be focused. Uh, because you've asked about this, I would like to say there may be opportunities. So if you want to track opportunities in US, what should you track? Technology is one thing. Uh, Pharma biotechnology is another thing. Then there is uh, uh, oil and gas. You have those Exxon Mobil's, etc. You'll have to understand what is Trump's plan and then research and make your call on that. Then one more opportunity would be in utilities. More the AI, more the need for energy, the more the boom for utilities. So these are sectors you can have. Consumption is something that I'm not a big fan of investing in the US because India is a faster growing consumption market than the US. So when you have your best opportunities homegrown, why do you have to go to the US? When a US stock grows 5%, do I earn 5% or more because you want to? Yes. So it depends. Okay. So you will benefit when, let's say, US stock grows up 5% and rupees today at 84 to a dollar, it goes to 86 to a dollar, your returns will increase. Your returns will increase. Yes. So from a historically, rupee has depreciated. Uh, uh, so to that extent, yes, you can benefit from currency depreciation if it happens. If what has happened in the past happens now, yes, you can benefit. But there is a short period between in 2007 when India was such a hot investment hotbed, rupee actually appreciated during that year. So we'll have to consider, but on a long-term basis, yes, rupee has continued to depreciate. Is it good to buy US stocks via ETF in Indian market? Uh, yes, these are good opportunities. My personal view is I would wait for better opportunities, but yes, these are passive investing is fine. SIP in passive investing is fine. You will have to make the call based on your individual circumstance. Next question. Uh, okay, see this particular, in, I've not come across this, but I suppose it's the FANG and M, I think is Microsoft. And so it's pretty much the Magnificent Seven stocks, actually. This is pretty much the Magnificent Seven stocks. So the same view. As a beginner, how can I identify for US stock, especially from the tech sector? Uh, uh, it's a good, yes. As I told you, you have to understand how are top-down valuations. Uh, in the indices valuations, are they expensive or cheap? What is the company's valuation? Where is the company in the cycle of its growth? And then the other thing is, see, right now AI is going to be the theme for the next decade. So, what is this company's unique moat in technology? So, as a beginner, I will say that this I carry forward from one person whom I have learned a lot from. He's called Mark Andreessen. He's the founders of a hugely successful venture capital fund called Andreessen Horowitz. He is the founder of Netscape also, which was one of the earliest web browsers in 95. So he was a tech innovator who has become a venture capitalist. So today he says they're investing in many artificial intelligence companies. They're investing in OpenAI. They're investing in OpenAI's competitors also. He says he doesn't know which one of these companies is going to be successful in the long end. So he's hedging his bets by uh, putting little bit money in multiple opportunities. Some won't work, but the few which work will make so much returns to make up. So if you're not sure as a beginner, divide your bets across multiple companies, enter at reasonable valuations. Uh, but if you want to make a concentrated bet, it is risky, but then you have to do deep research, understand the company, look historically how, let's say during the dot-com boom, see how many companies were there, like which one succeeded and what was the unique characteristics that made it succeed, factors like that. So the next question is, will you write regularly at least once review on ETFs that investing? See, this is I don't write much on mutual funds. My teammates write. So I will discuss it with them. And yes, once in a while I have written on US ETFs. As of now, as you said, the same view I've given earlier. I feel I feel valuations are expensive. What suggestions for beginners who want to invest? Yes. So if you are a beginner, I think at this point in time, I think you should thank your stars, okay? Because uh, I started, I was a beginner in the US markets in 2007. Uh, uh, I saw the boom, all right? When I entered US markets, Nokia was a $150 billion company. BlackBerry was a $100 billion company by end of 2007. iPhone came, they got crushed. Okay, they got crushed. Then the global financial crisis came, they got even more crushed. So if you are a beginner, you are at the best point to start understanding the US market, because we are in a hugely massive optimistic period now. So you start learning now. When a correction comes, you see how markets correct, which stocks correct. So I would say, if you are a beginner, only do your research now. Do your research now. Track market. See how competitive dynamics are crushing few companies. Like if you see how Nvidia has crushed Intel, right? Intel just Intel's core business is still okay. It's not like it's all that bad, but just that they don't have the best AI chips. Their business has been their stock has been crushed. So things like that. Okay, so track the markets and understand. In my view, this is the time to. This is one of the best times to research on US markets, because when you go through an upcycle and a down cycle, your learning will be vastly enhanced and complete. What do you think of iShares Bitcoin ETF? What will act as a see? I am a fan of Buffett, and if you know, he called Bit poison rat poison squared. I mean, Bitcoin rat poison squared. He's made the statement. He's His exact quote is, "I'm absolutely certain cryptos will have a bad ending." So far, it's defied his views, and for a very long time. Okay, so yes, if Buffett is wrong, this is the first time he's been wrong on a broad, convincing call he had given. I've followed many of his comments for decades, and everything, most times he said something, is largely worked out. So I am not a fan of Bitcoin, and our government is not, our regulator is not. So I think it's best to stay away from Bitcoin. This is my view. Is there a hyperlink subcategory on BL where to follow your? Yes, if you just Google my name, Hari Vishwanath Business Line, you will you will get a link to my page in Business Line, which will have a list of all my articles. And next question is, India listed US ETFs are trading at a see, the premium might be modest. Some premium, or like say, or a discount in ETFs is not uncommon. One reason why they may be trading at a premium is uh, there is a limit. There are no limits on mutual funds investing in the US. So when RBI, this is my understanding. I'm not sure. I can check further on that. So because somebody may not be there are times sometime back when mutual funds restricted inflows into their ETFs due to overall RBI caps on limits, RBI limit caps. Okay, so that could also be a factor for premium. Next. The questions come right on delistings. Yes. So this talk, as you say, has been had a crazy. Okay. So this question is on delisting of SMCI and my inputs on that. So this stock has had a quite a crazy run. The stock has, so you know how much it's up and how much it's down. This is the risk. So the SMCA is thanks. I would like to thank you for bringing up this question. This is why you have to be extremely careful in stock selection. Okay, uh, you make see a good stock falls 50%, Meta falls 50%, 70%. You buy, you will be rewarded. Nvidia falls, you double down, you will be rewarded. But if you had bought SMCI and you double down, you end up losing all your money. Don't go for such stocks. There are so many good stocks out in the market. If a sudden new stock has come out and it is a small cap, a mid cap, take your time to understand. Don't just go with what somebody else is saying. Take time, take your time, invest. After missing up on some of the upside, it is okay. You have to be convinced. To me personally, management quality is extremely important. So unless I know the management, I'm very confident of the management, I will never go for a stock or recommend. I'll try not to recommend, because of course we can't be perfect in our assessment of managements. So I'll try my best to understand the quality of the management. Like I gave you in the case of Facebook, try to understand the DNA of the company, DNA of the management. See, one thing that works in the US market is there are no promoters. Okay, so to that extent, if there is an inefficient management, uh, the shareholders can shunt out the management, have a new team in place. So to that extent, that's a slight positive. But then yes, you don't. Sometimes promoters bring more value, like we've seen in some of the Indian companies. We'll have to balance uh, between the two, and I would say don't go for companies that have fallen so much. SMCI already had a delisting incident in 2018. Really, I mean, shady management, it appears. I'm not making a conclusion, but this is ridiculous, right? Delisted, coming back to the market, then again getting delisted. The stock is now at 17. Uh, they did uh, like a follow-on public offer at 100 few months back, and investors lapped it up. Imagine the company was crazy to do that, like you could say unethical to do that. Investors were silly enough to lap it up. So go for a company only when you're read, learn, and then uh, keep your emotions as slow as possible the second before you make your investment decision. So the next question is focused on stocks. Indices are good. I think Nasdaq 100, uh, Mire Fang, I mean Fang ETF. Sorry, I don't want to uh, Fang plus ETF. Yeah. These are all good opportunities at right levels. So I feel they're overvalued. The next question is your views on impacted of expected deregulation. Yes. See, the bank stocks did very well after Trump came to power. Banking stocks have a heavy weight on the Dow Jones, which is why Dow Jones has been the outperformer from the time Trump has come into power. Uh, but the economy, if the economy slows down, already credit growth has shrunk a lot. Okay, the growth in credit has shrunk a lot after the regional banking crisis in the U.S. So deregulation will be positive, but it also brings in when there was deregulation in 2003 to 7, they messed up with it. Except probably JP Morgan, you could say, was the only bank that didn't mess up too much. That's why they bought Bear Stearns. They were in a better position, but their shares too tanked. So two things you will have to check when it comes to US banks. Deregulation will be a positive, but their earnings can get very volatile because when interest rates are cut, their net interest income will reduce. Okay, depending on their cost of borrowings and their cost of credit. So earnings can get impacted when interest rates with the Fed cycle has actually the cut that Fed has embarked on. The other thing is many US banks, the top Wall Street banks, have a huge component of income from trading, brokerage, treasury income, like their own proprietary trading businesses and all that. All this will get hit during a market correction and a slowdown. So you have to factor for that volatility when it comes to banking stocks, which is why if you see US bank trade at really, I mean, their P's are like 11, 12, 9. That is a PE of US banks. Price to book is also not expensive. This is because of the cyclicality in the sector. What is the ideal percentage of asset allocation in US stocks to uh, uh, see individual circumstances? But yes, you should have most of your investments in India because we don't know when what regulation can change. Maybe 10%, 15%. I would say if you want to be very aggressive, maybe 20%. But I think 10% is decent. You can take it that 10% is there because see, it's we don't know how taxation laws will change there, etc. So many things are there. What will be the impact on your investments, etc. Best to have most of your investments in your geography. Some 10 or 15, 20, you have to make that call.
Two more questions.
What is the best platform? So this is again, as I told before, if you send me an email, I will reply back with the earlier articles we have written, some platform reviews we have done. None of these are suggestions or recommendations. Uh, I'm happy at some point in time over the future, I'll ask one of my team members to again write on it if you want. Can you please name any fintech? See, PayPal is a fintech company. I actually gave a recommendation of accumulate on PayPal in that is business line at BL portfolio. I had written on it in uh, I think February or March of 22. I gave an accumulate on dips recommendation. If you Google my name and PayPal business line, you might be able to get that article. Uh, so it's now, but it's still down. Okay, so it's like it went down. Now it's at around 70 or so, actually 70, 75. So that call hasn't entirely worked. The reason being that. Now the companies like Apple have been eating a pie of the traditional fintechs. There are, but at some point you'll have to, I can probably get back and see and get back to you again on that. So fintechs are PayPal, then you have companies like you have a company called Square, which is now called Block Inc., which is a fintech which was founded by the same founder of Twitter, Jack Dorsey. So he runs that company. That also has been volatile. Many fintechs have been hit uh, because they all embarked on buy now, pay later, which has actually taken an NPA hit because consumers are under strain in the US due to inflation. And then the other thing is big techs like Apple, everybody is now trying to get into fintech. So you'll have to do some, these are the companies, but it's worth doing proper research before considering anything. What is the next question? Anything else?
Best platform for trading.
It's the same thing. So, yeah, next. India listed you. This also I've answered. So, any other questions you have? I don't mind waiting for a few. Yes, it is. It is insane valuation. Okay, so the question is, what is your view? Palantir's insane valuation. Uh, yes, the valuation of Palantir is insane, and but yes, it's got onto the AI craze. You know, its listing I think in 2020 was at $10 or $12. It went up to 35, 38 in 21, 22, then crashed to single digits in 23. Now it's up again. Uh, as I told you, that is US markets for you. Wear your seat belts, get ready for volatility, buy only when it is cheap from your perspective. When it is insane, maybe book some profit. That's a call you will have to make at an individual level. Which is what we did. We recommended at Meta when you made 5x returns in a 1 year period, and it's okay to miss on some of the upside. How can I? The other thing I wanted to point out is this thing, Palantir. Don't go for companies where profitability is uncertain. Okay, don't go for those companies. If you want, that would be my approach to US markets. How can I invest? Because that is why if you see Snapchat, the chart of Snapchat, I told you, it was barely a bit of positive when it got listed. It keeps fluctuating up and down, up and down. Go for companies that are have high free cash flows. Okay, that has been a trademark of the big technology companies which have got so big. High free cash flows has been a high profit margins, high free cash flows has been a trademark of those companies. So how can I invest in one? I think the platforms will allow you to invest in. Uh, yeah, the next question is how can I invest in Vanguard ETF from India? So I think all the brokerage platforms allow you to invest in iShares ETFs and Vanguard ETFs. Any books to read on personal finance? Yes, many. Intelligent Investor by Benjamin Graham, in my view, is a must read. That is a very interesting book. I learned a lot uh, uh, reading it. And then newsletters of Buffett's are brilliant. If you go to uh, Berkshire Hathaway's website, newsletters since 77 are available. Uh, Reading, so 77 till today, right? every year. The newsletters are every year are there. These itself clustered together will form one of the best investing book for the ages actually. So read Buffett's newsletter starting from 1977 because his newsletters refer to the economy at that point, inflation at that point, uh, logic of investing at that point. So Buffett newsletters are extremely helpful. What, what is your views on Oracle recent? Yes. So if you see, Oracle has been remarkable uh, in kind of their progress in cloud. Uh, I haven't checked its valuation of late. So, but it's the stock has done well. They're right up there. Oracle is a fantastic example of a company that has evolved. Okay, so they were the large. Oracle was one of the largest companies, let's say in 2007. Now they have been overtaken by many internet companies, but Oracle is a fantastic case of a company that has evolved. SaaS, software as a service revolution came, and then software as a service revolution came, and then so Oracle migrated to SaaS, and then they have they made the right migration for AI cloud also. Definitely a good company that you can have on your radar. What is your view on international repo rate impact of Russia-Ukraine war on US EU energy and intern effect on? Yes, so if you see, much of this has already played out. Uh, Russia-Ukraine war has been ongoing. Oil has gone up and come down. So I guess as of now, there is nothing incremental. Markets seem to have what there isn't much to infer on this. So, energy stocks, I mean, crude has fallen a lot. So, despite all these geopolitical uncertainties, which is surprising. So, which is why some analysts are saying that the Wall Street analysts who are bearish are saying markets have been very, very complacent of geopolitical risks actually. So, yes, if there is more volatility in energy, there will be a crude going up too much is also bad, as we saw in 2007. Crude going down too much is also bad. If you see the bear market of 2020 started just before COVID. Saudi Arabia started on a price for oil. Oil went up to $35, and that was very bad for global stock markets. So crude has to be in a Goldilocks zone because either ways it's very bad for markets. Uh, okay, so this company I haven't. Okay, the question was, what is your view on Cerebra's IPO and company? I haven't tracked it, so I'm unable to give any view on that. So thank you. I'm very happy I got this opportunity to interact with you. So you can write to BL portfolio. It is there in our website. It is there in our. It's also been given in the slide. So write to us. My intention is to try to respond to every single mail. If I missed any mails from anyone, I apologize for that. Maybe some time constraint, preoccupation with a few other things. But I will try to respond to every single uh, email. I'll try my best. Okay. Thank you. Good luck. Do well.